Hello everyone, this is Dr. Sonam Arora. Welcome you all to the next video session on theories of capital structure. In our last video session, we discussed about the relevant theories, and in today's session, we are going to discuss about the irrelevant theories. Now, when we use the word capital structure, I am repeating it again that it is a combination of your equity and debt capital. So, how it is your theory of irrelevance? So, there are different views on the effect of capital structure and its influence on the value of firm. Theory of irrelevance used to say that there is no relationship between the capital structure and value of firm. It means there is no effect of financial leverage on your value of the firm. Under this particular head, in the theory of irrelevance, we are going to use two different theories. The first one is your net operating income theory, again by the David Durant, and the Modgilini and Miller approach. Now, let's look about the net operating income approach. This approach, as I already told you, is proposed by David Durant. So, not get confused here. There is two different approach by the David Durant. The first one is a net income approach, which used to say that there is a relationship between capital structure and value of firm. And the second theory by the David and Durant is your net operating income approach. Now, how this work? So, the change in a debt proportion, or we can use the word in your financial leverage. So, change in the financial leverage in your capital structure will not lead to any change in the value of your capital. And again, the value of your firm, cost of capital and the share price are independent of a financial leverage. It simply means that if you are going to increase the debt capital in your capital structure, it will not going to lead to any reduction in your weighted average cost of capital. Why this happen? So when we say that why this happen, but before why this happen, we have to understand the assumption, because the answer lies in your assumption. So the first assumption taken here is that overall cost of capital remain unchanged for all degree of leverages. Why it remain unchanged from all degree of leverages? Because there is no importance is given to the split of debt and equity in the value of firm. So whenever we talk about the capital structure, we always do a proper classification in debt and equity. But this particular theory by David Durant used to say that there is no difference, there is no importance that whether you are going to use debt capital or equity capital. Practically it is not possible. There is a particular point where you have to give the importance to either your debt capital or the equity capital. We take one example here, which I already gave you in my previous sessions, that Reliance is going to move towards the zero debt based company. It is going to reduce his debt capital to the extent that it becomes zero. So there is no debt capital in the whole structure, the overall structure. The composition is of only and only of an equity capital. So if an organization wants to try to move toward the equity side, it means there is a cost of debt, and that cost is often cost of interest. But it doesn't mean that equity is free of cost, because you have to pay the dividend in that particular structure also. So either it is your debt or your equity, both come up with a cost. Now it depends upon the organization that which cost is in a better option. So either it is your interest on the debt or your dividend on the equity. But we can't say that there is a split. So everywhere there is a split which is definitely exist. Now the third thing is that market value of equity is a residue. So again, when we talk about the market value of equity, we have a very simple calculation. It is your V minus D. So if I want to calculate the equity capital, I have to do just one thing. I have know what is the debt capital and what is the value of a firm. So if I reduce the debt capital from the value of a firm, the remaining amount is of my equity. Then again it is not possible, because you are not use only and only equity. There is third structure which is your preference capital, and there is again your retained earning also. So in the picture there is no only two character. So till now we discussed that there are two characters in my movie, that one is an equity and second is a debt. But in a practical life there is four character. One is your equity, one is your debt, one is your preference, and one is your retained earning. And we can't simply say that retained earning or preference is not going to play any role. The fourth assumption is that the use of debt fund increase the received risk for equity investor, which is very true. If you are going to increase your debt capital, it is going to risk for the equity investor, because on the debt capital you have to pay interest, and the company is going to pay interest, then it is going to reduce its profit, because when we do the calculation, it is your profit which you use the word EBIT, and when I reduce the interest from it, it becomes your EBT, and the number of the equity shareholders come after your EBT. So if you are going to pay more interest, the profit for the equity shareholders can get reduced, and this can be offset by the increasing of cost of equity, because if you are going to increase your debt capital, definitely you have to increase your dividend, so you are able to attract more equity capital. So the everything is related to each other, and you can't use this particular assumption that you are not going to do the split of debt and equity. Now look at the graph. This graph used to say that the cost of capital remain constant. As the proportion of debt increases, it is definite to increase in the cost of equity, and there is no effect on the total cost of capital. Now we are going to understand this particular concept within the formula of a V. So the value of firm V is equals to EBIT divided by KO. Now here KO is your overall cost of capital, or your WACC, weighted average cost of capital. And as we use in the word of assumption that the market value of equity is residual, it means E equals to V minus D. Now let us take this particular concept with the help of an example. So there is a company, same as a Venkat Entail Company and Limited. We already used this example in our previous session also in the concept of net operating income theory. So there is one example in a net operating theory, and the same example is a net operating income theory. So this will help you to compare the both situation. So in the case of a Venkat Intel Company Limited, expect an operating income, or you can use the word EBIT, by 1 lakh rupees. The company has 12% debt of rupees 3 lakh, and the overall cost of capital is 13%. Now calculate the total value of the firm and equity capitalization rate. So when we talk about this, we already discussed it many times that a value of firm is equals to EBIT divided by KO, your capitalization rate or your cost of capital, or we can use the word WACC. So it is 7,69,2307. So ultimately it is near about 76 lakh rupees. Now when we add your equity, how we calculate the equity? We simply calculate the equity by value of firm minus debt capital, which is already given in the sum. So it remains somewhere between your 46 lakh rupees. Now let's look at this. If it is equity capital is 46 lakh rupees, your capitalization rate will be 13.64%. It is already shown in the example. Now your overall cost of capital is 13% and your equity capital is 13.64%. It means when you increase your debt capital, it is not going to reduce your overall cost of capital because it remains same. Whereas your equity capital is increased. It is increased by the 13.64%. It means the introduction of a debt capital having a no relationship between your overall cost of capital or on your value of firm. So this theory used to say in a nutshell that the relationship between capital structure and the value of firm still not exist, and theory is just opposite of the first theory given by David Duren. And on next session we are going to discuss the irrelevance theory with the help of a Modigliani-Miller model. Till now, stay safe, be happy, thank you.